In the gold rush of the AI and electric vehicle revolution, everyone is obsessed with the processors, the brains of the operation. But a brain without a heartbeat is dead. Today, we are going to talk about the company that controls the heartbeat of modern electronics, a company that has mastered the art of high-voltage power conversion. That company is Power Integrations, ticker symbol POWI. We have analyzed their financial journey from the boom of 2020 through the brutal correction of 2023. And finally, the recovery signals in their latest Q3 2025 report. If you are looking for a semiconductor stock that combines elite gross margins with a massive technological moat in gallium nitride, or GaN, this is the story you need to hear. Let's start with the context. Power Integrations isn't just another chip company. They specialize in high-voltage power conversion. Their chips are inside your phone charger, your smart home appliances, electric vehicles, and increasingly, the power supplies for AI data centers. Their mission is simple. Take high-voltage electricity from the wall and convert it efficiently into something your device can use without wasting heat. Back in 2021 and 2022, during the post-pandemic shortages, Power Integrations was flying high. Revenues were breaking records. But then, the cycle turned. The year 2023 was a disaster for the industry. In their 2023 annual report, the company admitted that revenues fell by more than 30%, the first time in history they had back-to-back years of decline. The supply chain was flooded with excess inventory, and customers simply stopped buying. The pain continued into 2024. Revenue dropped another 6% to $419 million. But this 2024 drop had a specific reason. Management made a tough, strategic choice. They decided to exit the low-margin Chinese cell phone market. They essentially fired a huge group of customers because the profit margins weren't good enough. This was a classic short-term pain for long-term gain decision. They sacrificed revenue to protect their margins. Now, let's fast forward to the present. The third quarter of 2025, ending September 30th, 2025, we have the 10Q report in front of us. What is the data telling us? First, the top line is growing again. Net revenues for Q3 2025 came in at $118.9 million, up from $115.8 million in the same quarter of 2024. If we look at the first 9 months of 2025 combined, revenue is $340.3 million, compared to $313.7 million the previous year. That is an 8.5% increase year-to-date. The recovery has officially begun. But here is where you need to be a smart analyst. If you look at the bottom line for Q3 2025, you might panic. The company reported a net loss of $1.3 million. Compare that to a profit of $14 million a year ago. Why did they lose money if sales are up? We dug into the footnotes to find the answer. It is not because the business is broken. It is because of two one-time events. First, stock-based compensation exploded to $21 million this quarter, up from $8 million last year due to an award modification associated with the retirement of their former CEO. Second, they recorded a $14 million expense related to a litigation matter. If you strip away these one-time costs, the core business is incredibly healthy. Look at the gross margin. In Q3 2025, it stood at a staggering 55%. This is elite. Most hardware companies dream of 40%. Power Integrations is maintaining 55% margins even during a recovery. This proves their pricing power and the value of their technology. Speaking of technology, why should we be bullish on their future? The answer is GaN Gallium Nitride. Silicon chips have reached their limit in handling high power. GaN is the future. It is smaller, faster, and cooler. Power Integrations has a proprietary technology called PowiGaN in their recent reports. They highlight that their GaN chips are now approaching cost parity with traditional silicon. This is a game changer. It opens up massive new markets. Specifically, they are targeting two high-growth areas. Number one, electric vehicles. Their chips are used in the emergency power supplies and gate drivers of EVs. Number two, AI data centers. AI servers consume massive amounts of power. Efficiency is no longer a luxury. It's a necessity. Power Integrations' high-efficiency chips are perfectly positioned to solve the heat problems in these data centers. Let's look at the balance sheet in the Q3 2025 report. It is a fortress. They have approximately $48 million in cash and cash equivalents. But more importantly, their operating cash flow for the first 9 months of 2025 was a positive $85 million. They are generating cash even when reporting a net loss on paper. This allows them to pay dividends and buy back stock, which they did, repurchasing nearly $98 million worth of shares in the first 9 months of 2025. So, what is the verdict? Power Integrations has weathered the storm. The inventory correction of 2023 is behind them. The strategic exit from the cheap China phone market is complete. They have successfully pivoted to high-margin industrial and automotive markets. The loss in Q3 2025 is a red herring, a distraction caused by executive transition costs. The real story is the 55% gross margin and the return to revenue growth. As we move into 2026, with the wind of GaN technology at their backs, Power Integrations looks like a coiled spring. They are a smaller, leaner, and more profitable company than they were during the last boom. And in the world of power, efficiency always wins.